So moving into continuing our discussion about bonds. So we discussed how we account for bonds with premiums and discounts. We discussed how we account for bonds that have debt issue costs. Now we're going to discuss what happens if we have a bond outstanding and we decide to retire it or extinguish it early. Essentially, what we're saying here is that we are going to pay off the value of the bond prior to its scheduled maturity date. So some of the reasons why we might do this, if the company doesn't have a cash flow problem anymore, right? So sometimes when they issue bonds, it's because they need additional cash flows. Well, if we're not in that situation anymore and it's a little sooner than we initially thought, we may want to just pay off those bonds earlier so that we avoid having to pay the periodic interest. And so again, this is what we're gonna go through as an example of what happens if a bond is retired, extinguished, paid off, whatever terminology we want to use, early, so earlier than its scheduled maturity period. So we're going to use the same bond example that we went through in a previous lecture where we had a bond that was sold at a discount. So on January 1st, 2021, we had a bond that was had a face amount of $700,000, had a stated interest rate of 12%. It was a 10-year bond, and the market rate of interest at that time was 14%. So what we're adding on to that initial problem. So again, we're taking over where we left off with a bond with a discount. What we're adding on to that is now we have this call price. I actually don't like that very much, but that's okay. We have this call price, right? And where it says that if Masterwear Industries, if we decide that we want to call our bonds, if we want to retire them early, if we do so on January 1st, 2023, we've agreed to pay a price of $635,000. So here is where we're saying we're not going to pay the full face amount like we would if we waited 10 years when the bonds actually mature. We are instead going to agree, and this would have been set up in the original bond indenture in the original bond contract. We're going to agree to pay on January 1st, 2023. If we decide to retire on that day, we are going to agree to pay $635,000 to our bond holders, to our bond investors. So here's all of the detailed information. And again, it's all of the same information as the previous bond discount example. We already went through the present value calculation when it comes to the sale of the bond and what was the price of the bond on the day that we sold. So we would have used number of periods would have been 20. Our market rate of interest would have been 14% divided by 2. Our payment amount would have been $700,000 times 12% divided by 2. Our future value would have been $700,000 and our type was 0. So we include all of that information into our present value calculation. The total value of the bonds on that day that we sold them was $625,000, which means we would have had a total discount on bond payable of $74,158. So the face amount minus the present value gives us the discount, the total discount that we would have had. So I created this amortization schedule to show essentially what would have happened over those first 2 years that we would have had that bond outstanding. So on January 1st, we had the bond outstanding. It had a price or a principal value of $625,000. On June 30th, we would have made our first interest payment. The interest payment would have been $700,000 times 12% divided by 2. The amount of interest expense that we would have recorded would be the outstanding value of our bond times the market rate of interest. And then again, because this is semi-annual, it would be divided by 2. So using the effective interest method, right, we take the outstanding value of our liability, we multiply it by the market rate of interest, divide by 2. The difference between our interest expense and our interest paid would be the amount that we would have adjusted our discount. So our discount started at $74,158. On June 30th, we would have decreased that discount by $1,808, which means our total principal amount or our bond value after June 30th would be $627,650, which is our old bond value from the previous period plus this adjustment that we made to our discount. Remembering, with a bond discount, we start with a lower than face value, and we work our way over the maturity period. We work our way up to that face amount. So we start low at a discounted price, and we work our way up by amortizing that bond discount, the discount on bond payable. So that's sort of how this amortization schedule is set up. You can see that each period, the same exact process happens. So on each of these interest dates, we account for interest expense using the effective interest method. We compare that to what we actually paid out in interest, and that becomes then what we remove or what we adjust with our discount. If we did that for the first two periods, we would have wound up with a bond value of $633,873. So after 2 years of accounting for and paying these interest payments, our current bond value would have been $633,873. So what we're saying here is the bonds are actually going to be retired on January 1st, 2023. So that's just the next day, right? So the next day the bonds are going to be retired. So we just carry this 633,873 to that next day. What we have to do is basically understand, right, what is our bond value and how does that compare to the amount that we've agreed to pay? Well, our bond value is $633,873. And we agreed, I'm going to subtract, we agreed to pay in our bond indenture, in our contract, if we were going to retire early on January 1, 2023, we agreed to pay $635,000. So notice there is a negative $1,126 difference between the amount that our bond is worth right now and the amount that we are paying. We are actually paying more than what the bond is worth. So this is going to come through in our retirement journal entry. We have to make a journal entry when we retire these bonds. In that entry, this is going to come through as a loss. Because again, think about it. Did we win or did we lose? Well, our bond is worth $633,000 and we agreed to pay $635,000. We're actually paying more than what it's worth. So we are going to lose or record a loss on the retirement of these bonds in this example. Okay. One other thing that we have to be aware of when we're talking about sort of what's the entry that we're going to have to make when we retire these bonds early is how much of the discount do we have left at this point in time. So on January 1st, 2023, how much discount have we amortized so far? Well, we amortized on June 30th, 2021, December 31st, 2021, and then again the following year on June 30th and December 31st. The total amount of the discount that we would have amortized so far is $8,031.56. So how much of our discount is left over? Well, we started with a discount amount of $74,158. If we amortized or decreased the value of that discount by $8,031 over those first 2 years, then the amount of our discount remaining is $66,126. We need that information because we're going to have to essentially remove the remaining discount on our bond when we go to retire these bonds early. So you can see here on the right-hand side, I've created sort of a set of steps that we're going to go through in order to account for the retirement of these bonds early. The first thing that we're going to do is remove the bonds from our accounting record. So when we initially recorded those bonds, we would have credited bond payable $700,000. If I go over actually to my discount problem, you can see that that's what we did. We made a credit to bond payable of $700,000. What I'm saying now on this early extinguishment or early retirement tab is I want to show that those bonds are no longer going to be on my accounting records. So I'm going to debit bond payable for $700,000 for the face amount. We originally put them on the books for $700,000. We take them off the books for $700,000. In addition to removing the bond payable, as I said, we needed to know how much more discount do we have because that discount also needs to be removed from our accounting records. If you remember, we would have initially recorded that discount on our records as a debit. It was offsetting. It was sort of doing the opposite of what the bond payable was. So if we want to remove discount on bond payable, we're going to do so with a credit. And that credit we already calculated needs to be $66,126. Number 3, we're going to record the cash paid. So again, we were told in the problem that the amount of cash that we are going to pay to retire these bonds is going to be $635,000. That's the amount that was given to us in the problem. And then the last piece of this is what we already calculated as our loss on retirement of bonds. This could be loss on early extinguishment of bonds. It could be labeled however we want, but it needs to be accounted for as a loss. That loss appears on our income statement with other gains and losses. That loss, because losses act like expenses, that loss is going to be a debit, and it's going to be for I'm making it negative, so that two negatives will create a positive in my entry. A negative $1,126. So again, what we're showing here, and what I can do one final step just to make sure my journal entry balances. So I have debits, and let's figure out our credits. So our journal entry does balance, because what we're saying here is that because we have sold these bonds or paid for these bonds early, retired them early, and on the day that we were retiring them, our bonds were actually worth a little bit less than what we agreed to pay, we lose. We have a loss in that situation. And you'll also notice that I don't have all my debits together and my credits together for these lecture purposes, and I'm not too concerned with all the debits being first and the credits being second, just because I'd rather go through this in a way that makes sense, in a step-by-step manner, where we're saying, okay, the first step is to take off of the books the bond and the discount. The second step would be to go ahead and record the cash that was paid. And then the third and final step always needs to be, well, did we win or did we lose? Do we have a gain or a loss? So normally in an accounting system, we would want to see these two debits together. So the debits would be first in our entry, and then the credits would be second. But I'm not super concerned with that for just educational purposes. So that's an example problem where we're talking about the early extinguishment of debt. So we have debt outstanding. It has a scheduled retirement period, but we decide we want to basically retire, pay off